Welcome to the Advanced Course Remastered, Lesson 4, Entries. Great news. It's now time to start taking some trades. We've done all this groundwork in preparing ourselves from the beginner's course and advanced course, and we've created the foundation that's going to allow us to now look at trades, spots we can get into, and how we can start to define the criteria of entering one of these trades in order to find the best spots possible on our charts. Now, you're not going to have all the tools just yet. I have many more courses beyond Advanced Course Remastered that are going to teach you deeper and further parts of technical analysis, mental analysis, comparative analysis, and procedural analysis. These are deeper and deeper and deeper forms of analysis that we use in day trading that help guide you through better trades. With that said, we are going to use the things that we have learned in the advanced course to start to think about where we can take these entry spots. And the first one we're going to talk about is our peaks and valleys. As an opening criteria, this is the perfect place to start. Peaks and valleys kind of create this juxtaposition or a moment of contrast in the charts, a moment where it's very black and white. It's either going to continue going one direction or it's going to go in another. So the great thing about peaks and valleys and the way that we've learned them is that typically when a peak gets attacked, it breaks down to go to a much lower level. If a peak doesn't get attacked though, and say a peak goes and holds the move up slightly above the price or maybe even a little higher than slightly above the price, you are going to be continuing to move up. Think of this as a level that supported the move. So there's kind of this very interesting thing that happens when you have a peak or a valley on your screen, where if the peak doesn't quite get hit or the valley, then you are going to be moving in the direction that tried to reject that move. So if you are traveling down towards a peak and at the bottom of that peak, you had your level of support, if it doesn't hit that level of support but stays above it, technically it means that that peak was never hit and you're likely going up into the other direction. Now, if that peak did get hit, well, I think you guys have seen in the previous examples what happens when the bottom of a peak gets hit as support. Okay, slow down a second, Cotton. In the beginner's course, you told me that if I have the bottom of a move or the swing low, you mark that as support for a move. Well, this is still true. Or if you have the top of a move, you mark that as resistance for the same thing, support. Well, this is still true. But what I want you to now realize is while that may be support, it can also fail that support and move down. However, if it was to stay above that support, well, it's never testing that level to begin with to break the move. So as a great initial criteria of entry, if we had a peak or a valley with the bottom of the move, if we simply stayed above that, well, technically we haven't tested that support, and that sounds like a pretty good entry since in a technical sense, it's still supporting the move and it never threatened to break it down. Rather, it's just laddering up and creating a trend. Aha, we now created a trend with our move. We laddered in the direction because we never tested that swing low, which still could be support, by the way. But if it doesn't test it, it's guaranteed to be support. And we've now made a trend out of that. So in one swoop moment, we kind of created a couple different magical things. We created support for the future. We rejected the move in terms of breaking down past that peak or above past the valley. We also created a trend, and now we have the criteria for a great entry, or at least when we look at it, something that can show us where the entry happened so that we can react soon thereafter. So this would be one way to see where a good entry would be. The criteria is right there on your chart and it never really threatened to break the move down. So if it's not threatening to break the move down, well, it only has one way it can go, which is up. Now, if you think back to earlier lessons, we had an example with the S&P 500 where we talked about a trend being broken after it had tested the bottom of a move and possibly going up. Well, our prediction came to fruition and we were right about the move. S&P 500 simply broke trend and it went up to a new level. Let's talk about that trade for a second and dissect the entry and how we could have treated this. All right, looking at the S&P 500, we can create the peak of our chart from the daily time frame. We simply go and mark the bottom of the peak that we were targeting in the previous lesson, and we are going to mark it with a level. As long as we stay above this level, we know that it's never targeting that to threaten the move to break down. Now, let's switch to a smaller time frame, maybe the 4-hour, and you can see where you had a few different wicks on the chart where you tested around that area and the move held. Well, this is starting to become great entry for the move up. It would be a great spot to buy as it's not really threatening the move to go down. Therefore, it will be creating smaller trends on your chart that are supporting the move up, and it's still laddering in that same direction towards a higher target. Again, the key piece of information here is as long as you stay above that level of support that we marked, the level that is targeting the move to break down, it can never break the move. Think of this as a glass that's on the counter. If you never drop that glass to hit the ground, how can it shatter if it's still sitting on the counter? This is the same thing with trading. If you have levels that you know will break the move, if you never target those levels, well, you're simply holding the move in the same direction and you're continuing to ladder in the same move up. Now, there's a lot of different ways to see how you could have entered this trade. So don't worry if you're sitting here saying, Cotton, I've broken down all these timeframes and it looks like there was lots of spots to enter this trade where that same scenario wasn't happening. You will learn those more advanced ways in order to assess these trades in the moment. But for now, I think a good rule of thumb is going back to the beginner's course and thinking about that lesson we talked about where I continuously move the target down, 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 down. The greedier it can go, the better off you're going to be. The example where we had a $2 trade where we said, well, $2 is good and actually it's great, but $1 is even better. And at $1, it was also a good trade, but 50 cents was even better. I think this is very relevant in the way that you need to look at entries on your chart. If you had a target on, say, the S&P 500, which at the bottom of the move was roughly $3,700, you could sit there and say, well, $3,800 is good, but what about $3,750? Well, $3,750 is good, but what about $3,740? Well, $3,740 is great, but what about $3,730? So you can constantly kind of reduce your own targets down and just get to a point where you're not quite breaking the move of support in that level where you've created that peak at 3,700 exactly. But maybe you can just go for a few dollars above that can still kind of represent this thing as moving up in the direction you want it to, but not targeting the move to break it. So I think that's the best way to treat these trades and is the most powerful way that you can reduce risk. Constantly looking for greedier targets just like we talked about in the past, but now using everything that we've learned to create that as a criteria of entry. Something where you can say, hey, I'm pretty confident that this thing is going to move up if it holds over this critical moment. And typically it will do exactly what you want if you're using all your technicals in the right way. You're going to learn more and more advanced ways to kind of dissect these entries and find different places you can enter because in all reality, this is just one of many different ways in where you could enter a trade and just one scenario that we created in the advanced course. There are dozens of different types of setups that you can do like this. There are never going to be moments where you don't have an opportunity on the charts or you're just simply running out of spots to take trades. That will never happen. And in my future courses, we'll go over that. In the Advanced Course Remastered, we just worked on creating the foundation from the beginner's course, advancing it to a better place, and looking at some of the first criteria in which we can enter trades on. We're not quite done with the advanced course yet. We have one more lesson, and that's exits. What's a good technique, and what are the best ways to exit a trade once you're in it? You're in profit, so what's next? Well, in the next lesson, we're talking about all things exit. So for now, I'm exiting this lesson, and I'll see you on the next one.